Hello and welcome to Alpha Recap. I'm Jude. Today we're walking through the week's sector storylines, why data centers and chip capacity are creating winners, where consolidation is reshaping materials and logistics, and why energy and crypto headlines are suggesting caution. With me is Alex, our cheerful financial educator. Alex, great to have you.
Thanks, Jude. Great to be here. There was a lot this week, but the broad theme was pretty clear. Real economy investment and corporate consolidation on one side, and commodity and digital asset caution on the other. Let's unpack it.
Let's start with the big, attention-grabbing deal. Talon made a purchase tied to data centers. How big was that, and why should listeners care?
Talon bought about $3.4 billion of capacity, roughly 2.6 gigawatts in the PJM grid. That's the sort of move that turns data center demand from a vague tailwind into real, contractable cash flows for utilities and power developers. In simple terms, it's money moving into physical power, and that creates a ripple across construction, materials, and regional utility balance sheets.
So data centers aren't just a tech story, they're connecting the whole chain.
Exactly. Think of it like this. Data centers need power. So utilities and independent power developers get long-term customers. Those customers hire industrial contractors who buy materials like copper and specialty components, and that benefits materials and construction firms. It's a multi-year, multi-sector demand loop.
Capacity builds were another headline. TSMC showed up, along with medical and defense suppliers. What's the investment angle there?
TSMC and companies like Becton Dickinson and Kratos are expanding U.S. capacity. That means steady equipment orders for suppliers, precision tools, specialty chemicals, and engineering services. For investors, it's a durable revenue story for industrials tied to chipmaking. If you want broad exposure, consider the industrial sector ETF or pick suppliers focused on semiconductor production.
Materials also had some notable consolidation and policy nudges, right?
Yes. There was about a $1 billion solid waste services merger, plus government pushes like a $450 million alumina and gallium support program and local recycling grants. For example, $500,000 in Indiana. Consolidation like that improves route density, pricing power, and margins. Smaller operators become takeover targets, and larger firms can re-rate as predictable cash generators.
Those are the positives. Now onto the cautious side. Oil retreated and Goldman Sachs trimmed its long-term Brent outlook. What does that mean for energy investors?
It means energy equities are vulnerable. Analysts are saying supply now exceeds demand after a geopolitically driven price spike faded. Producer stocks tend to track oil prices closely, especially the high beta names. The practical move is to trim direct, high-risk oil exposure and, if you want energy, favor integrated majors with diversified cash flows and strong free cash flow yields.
And then there's crypto. Security failures and a public spat between the White House and Coinbase. How should listeners think about that mix?
Two things. First, many hacked crypto projects never fully recover, which highlights asymmetric downside for smaller, governance-light tokens. Second, the White House and Coinbase exchange on stablecoin rules brought regulatory focus to the forefront. For investors, that means trim speculative crypto holdings, favor regulated custody and exchange providers like Coinbase, and keep crypto exposure to a small, tactical sleeve. Say 1 to 3% of a liquid portfolio unless you have very high risk tolerance.
You mentioned corporate and sovereign experiments too. Stake and Shake and central bank digital currency flows made headlines. Is that a counterpoint?
It is. Stake and Shake's $10 million Bitcoin buy is a signal event, and central bank digital currency trials are large in scale. About $55 billion reported in flows in some programs. Those developments suggest long-term infrastructure opportunities, custody, regulated tokenization, and enterprise-grade payments. But they don't offset near-term regulatory and security risks for small tokens.
Let's get practical. What are the tactical moves for the next 1 to 3 months?
Tactically, consider overweighting industrials and materials by about 3 to 5 percentage points, because CapEx and consolidation are the immediate catalysts. Increase utilities with data center exposure by 2 to 4% for defensive contracted cash flow. Trim direct energy equity exposure by about 3 to 5% until oil fundamentals settle. Reduce speculative crypto positions and reallocate to regulated infrastructure. And if you hold large cyclical positions, hedge with options or protective put spreads on sector ETFs to limit downside.
And for the strategic horizon 3 to 18 months?
Build a core allocation to beneficiaries of data center growth, utilities that can contract capacity, data center real estate, network and fiber providers, and semiconductor CapEx suppliers. Allocate to consolidation winners in materials and waste services. Position for more regulatory scrutiny in digital assets by favoring enterprise-focused infrastructure and regulated finance firms. And keep commodity exposure diversified. Avoid concentrated oil longs without conviction on supply tightening.
Any quick portfolio checklist to leave listeners with?
Sure, rebalance toward your targets. A sample tilt might be plus 4% industrials, plus 3% utilities, plus 2% materials, minus 4% energy, minus 3% speculative crypto. Use sector ETFs for broad exposure and single names for conviction ideas. Harvest losses if trimming energy or crypto to offset gains. And keep 5 to 10% cash to pounce on policy-driven sell-offs or M&A opportunities.
Where do the biggest risks and opportunities overlap?
Opportunity. The data center and semiconductor CapEx cycle is durable and touches many sectors: industrials, utilities, materials, and real estate. Risk. Regulatory shocks and commodity re-ratings can hit small cap and leveraged players hardest. Consolidation in waste and logistics is another opportunity, while crypto security failures and governance issues are the major downside risk.
Before we wrap, what should listeners watch next week that could change this picture?
Watch for any follow-on utility M&A, concrete timelines from TSMC, and fab suppliers for U.S. ramps. More regulatory commentary from the White House or the securities regulator on stablecoins, and any analyst moves on oil forecasts. Those items will tell us whether this split between cyclicals and risk assets widens or narrows.
Great. Let's finish with 3 clear takeaways for listeners.
1. Data centers and chip capacity are a durable, multi-year structural theme, and they create cross-sector winners. 2. Trim speculative energy and crypto exposure now. Favor integrated energy names and regulated crypto infrastructure instead. 3. Use active risk controls, position sizing, hedges, and policy monitoring, because regulatory and commodity shocks can happen fast.
Perfect. Thanks, Alex. Very clear and practical. That's our recap. Data centers and consolidation driving winners, oil and crypto posing the biggest risks, and sensible tactical tilts for both. Thanks for listening to Alpha Recap. I'm Jude. See you next week.
Thanks, Jude. Stay curious and keep an eye on the headlines. They'll move the market.